Hi everyone, welcome to my channel. I hope you're enjoying your day. Please like and hit the subscribe button. Share our video to anyone who needs to know this. Today, we're talking about capital gains tax. What is capital gains tax? If you have an asset, and we've talked about an asset is your vehicle, your house, even your shares are assets, right? If you have an asset that you've purchased and you sell it, right, you will make a gain or a loss. Either way, there's a difference between the selling price, the price you're selling it at, and the cost price, which is the price that you purchased it. So let's look at a house, for instance. You might buy a house in, say, in Bryanston. You might buy for 2.8 million. You might make some improvements and 3 years later decide to sell it for 3.8 million. So you have gained R1,000,000. That is what we call capital gains. However, you need to make sure that you include in your capital gains calculation any costs for repair, any costs associated with the agent, the commission that you've paid to an agent when you're selling, any other expenses that you can prove. Why is this important? Well, I'll tell you why. You will need to declare to SARS on all the assets you've told your selling price and then deduct your cost price as well as the other expenses incurred. If you do not do that, SARS will simply tax you on your gross amount that you sold the property for. That is what we call capital gains. Your asset would have gained and the capital amount will then be liable for tax. Now remember, capital gains tax is taxed at the same rate as any other tax. So if you are owning that property in your personal capacity and you then buy and sell or sell and buy, that means you're going to be liable for capital gains tax at the individual tax tables, which we all know are at a sliding scale and are a killer. If it's a company, then at least you know that you're being taxed at 27%. Make sure that you know exactly what it is you need to do. You have all your receipts, your slips, you have the initial offer of purchase or offer to purchase so that you can prove what you paid for the building. If it's land, again, the building aspect that would have gone into it before it became an actual, livable property, you need all those costs because obviously it would have gained a lot in value. Therefore, the capital gains would have been high. But you can deduct the cost of the land, the cost of your construction company, your materials, as long as they've given you invoices for all the work and all the material. So make sure if you're selling a property, you are declaring it on your income tax return. If you have an accountant, make sure they know about it and make sure that the details are kept. Your offer to purchase from the buyer also needs to be kept so that when SARS asks for proof of the selling price, the purchase price, and so on, you have it easily available. Now, having declared your capital gains, having filled in, you must know that there's also a rate at which SARS will tax, and there's also issues such as whether it's your principal place of residence. So there's other factors that are too technical for me to do with here, which you would need to consider if you are doing a capital gains calculation. So if it's not an investment property, then there are special inclusion rates. If it's an investment property, then it will definitely be capital gains applicable. Please contact someone who is well knowledgeable in the facts to make sure that you do not find yourself in a black hole. Some clients have simply bought and sold property, never filed a tax return, never reported, and when SARS finds out, from the deeds office, of course, that a certain individual sold a property, they check your tax return and they see that you did not declare it. Then you are now subject to not only tax on the gross amount, but penalties. And of course, those penalties and interest can actually shoot it right up. So make sure you do the right thing, declare your capital gains, and pay your taxes.